Hello everyone, thank you for joining us today, whether you're joining us live or whether you are listening to this recording from our website. Really good to have you with us. So today in our Tax Insights Live session, we are talking about selling a company to an employee ownership trust. So first, we're just going to talk about what that is and what it actually means. So where a controlling interest is sold to an employee ownership trust, and certain criteria are met that obviously we'll run through today, there are capital gains tax reliefs for the seller. There should be no capital gains tax for them to pay. And then on an ongoing basis, the company can pay tax-free bonuses of up to £3,600 per year to employees. National insurance does still apply, but they are tax-free. So using this as a method of succession planning can enable a seller or a group of sellers to pass a business to their employees in a really tax efficient manner, and also to ensure that their employees benefit from it going forward. So it's a very, very popular structure. So how does it work? Let's talk about the basic steps first. Typically, a qualifying employee ownership trust is set up with trustees, and then the shareholders in the selling company sell a controlling stake, so more than 50%, to the EOT under a share purchase agreement for market value, and that's usually determined by an independent valuer. We're going to talk later about some of the changes that have come in that mean that it really is important that is the right value, but it's always been important to use a valuer to ensure that business is being sold for market value. Usually, the purchase price is left outstanding as a debt and then paid back to the vendor shareholders over a period of time from the ongoing profits of the company. There might be trading reserves that can be used, but ongoing profits usually used as well. And the EOT will then pay the deferred consideration out to the owners over a period of time. Alternatively, the EOT could have debt financing from an external body to pay the vendors, which enables vendors to receive a greater portion of the purchase price up front, obviously reducing the risk to them. There are many lenders who do understand this structure, but not all of them. So it's just important to make sure you're talking to the right lender if you're looking to actually get third-party financing in. Have to be careful about the way that the funds move, because if funds are loaned from the company to the employee ownership trust, there can be a charge under the loans to participators rules. So you have to just be a bit careful about how it's all structured, but it can be made to work with third-party financing as well. So what are the conditions that have to be met for an EOT to be qualifying, and therefore all these tax benefits we've talked about to be available? Firstly, there's a trading requirement. It has to be a trading company or the holding company of a trading group. So things like property investment companies won't qualify for this. It does have to be a trading company or the holding company of a trading group. All employees must be entitled to benefit on the same terms. You can have a qualifying period, but the terms available to all employees must be the same for everybody to make it fair and equitable amongst the employee group. Specific individuals are excluded and can't be qualifying beneficiaries. And essentially, this is anybody who has or has in the past 10 years had a 5% shareholding in the company, and on winding up would be entitled to a 5% shareholding. So ongoing, the existing shareholders, essentially, unless they're very small shareholders, are excluded. There is a controlling interest requirement. As we've said, the EOT does have to take more than a 51% stake in the company. In reality, we usually see 100% stake, actually. So it's usually a complete sale, but it does have to be at least 51%. And it does have to maintain that controlling interest. It can't drop below the 51%. And we'll talk a little bit later about the interaction with employee share schemes and the impact that they can have on that. There is a restriction in terms of continuing shareholders. So broadly speaking, the shareholders who are continuing with the company and those connected with them who own more than 5% can't make up 40% of the total employees of the company. So this is supposed to stop vendors taking advantage of the relief, essentially to just continue in pretty much the same way as they always were. But it can create a problem where there are quite small employee groups with continuing shareholders making up a greater portion of them. So you do have to check those rules. And the definition of connected is different for every different purpose in tax. But for this purpose, as well as parents and children, brothers and sisters, it does include uncles, aunts, nephews, and nieces. So a very, very wide-ranging definition of connected persons for this purpose. So the current owners can be minority shareholders after the sale, but they're limited in the amount they can hold by that requirement in terms of the limited participation. So let's give an example just to illustrate how this can become more complicated than it sounds and can be a problem. So for illustration, Will and Kate own half of the ordinary share capital of WK Limited, and their 3 children, Kate's mother and brother, all work for WK Limited. In total, there are 20 people employed in the company, including Will and Kate and their relatives, when that company is sold to an EOT. On the date of the sale, the participator fraction is 6/20. 6 employees who were unconnected to the family then left the company, and Kate's sister and husband started working for the company, therefore increasing the participator fraction to 8/16, and therefore exceeding the 2/5 participator fraction. So this is a disqualifying event for the EOT. So no other employees were recruited within the 12-month period. So there is a period of grace. So even though this was all beyond the trustees' control, it's still a disqualifying event for the purposes of the Employee Ownership Trust legislation. And the arrangements are disqualified. Essentially, there would be a clawback of the capital gains tax reliefs. And we'll talk about how that works in a little while. As we've said, usually 100% of the shares in the target will be sold to the EOT. But it's not completely unknown for there to be a smaller holding sold, say 51% or 75%, and then people want to reduce their holding as time goes on. It does happen. But when shares are retained, the selling shareholders need to be aware that any subsequent sale in a future tax year will not benefit from the EOT reliefs. So it's a 1-year only relief. So if someone sells a 51% holding, and let's say the next year they sell, another 24% to make 75%, and then the next year they sell the remaining 25%. Those second 2 tranches will not benefit from these EOT reliefs. So really, really important to make people aware of that so they can try to align the tax benefits with their commercial commercial objectives. And of course, as always, we would always say, the tax should not completely drive the structure. The commercial objectives have to come first, but it does all have to be looked at in the round. And certainly shareholders will need to know what their position is going to be, even if they do decide to continue with the tranche by tranche sale. So what are the advantages of using an EOT for succession planning? So firstly, a market can be created where there's no trade buyer available. So we've had this several times where owners want to sell. I've had this quite a few times in the years since COVID, actually. Sellers who've had a company for quite a long time, obviously been through a number of recessions, have been through the COVID disruption, been through Brexit. Quite a few people have said, I just can't do this again. I just can't go through another recession or another period like this. I want to sell. But there isn't necessarily a buyer out there. So this can actually create a market where there isn't a trade buyer available. Obviously, no capital gains tax for the vendors if it's all structured properly. So that's a huge advantage, particularly since the lifetime allowance for entrepreneurs relief, business asset disposal relief, as it's now called, has been reduced to £1 million from £10 million. This is much more advantageous than that. And as I'm sure you know, the business asset disposal relief rate has gone up to 14% from 10%, and next April will go up to 18%. So having no capital gains tax whatsoever becomes more and more advantageous. This enables succession in family businesses where the children don't want to run the business. We've seen this lots of times as well, where there are children and the parents always had the idea the children would take it on, but either they just don't want to, they don't have the interest, or they don't have the right skill set. Perhaps their skills and interests lie in a completely different area. So actually the family business isn't going to be able to carry on, but perhaps there is a group of employees who are willing and able to continue to run the business. So this can work really well in those circumstances. It aligns the objectives of the employees and the owners, so it encourages them to have a more active role in the business. Obviously, they are going to benefit from the ongoing success of the business, so it's really in their interest to work as hard as they can to make it work. There is actually quite a lot of research and evidence which suggests that employee-owned companies have lower sickness rates, lower staff turnover, higher productivity, higher morale, lots and lots of advantages coming from having everybody feeling they have a slice of the pie and they're part of something. And so the psychology of it is really, really important as well. It does provide some flexibility over whether the sellers sell some or all of their shares. As we've already said, if they don't sell them all in the first tax year, then there will be no CGT exemption in the successive years, but it can enable a phased exit, whereas obviously a trade buyer might not give quite so much flexibility in terms of what they're prepared to agree to. Current owners can remain directors of the business and receive market rate salaries. And of course, employees can receive tax-free bonuses of up to £3,600 per year. Although, as we've already said, NIC is still payable. But for somebody's earning something like £30,000 a year, obviously getting £3,600 tax-free is really, really significant. So it can be very motivational to employees. So what do we have to consider and be careful of when we're talking to people about entering into this arrangement? Because, of course, as well as telling our clients all the benefits and the advantages, we need to make sure they're really aware of any drawbacks. I think the main one that clients need to be aware of is that the company will need to remain profitable. Otherwise, the shareholders won't receive their full consideration. There is a risk to them. And provisions can be put in place to stop the ongoing management paying themselves huge bonuses or buying a building or doing something else that would be considered, reckless or unfair before shareholders have been paid out. But at the end of the day, if there isn't any profit, then shareholders won't receive their full consideration. So they do really need to be, aware of that risk. And that's why, as we said at the beginning, sometimes it is actually worth getting third-party financing in so that a greater portion of the purchase price can be paid upfront. Next thing to be aware of is that disqualifying events can remove tax benefits. So if the company ceases to meet the trading requirement, that will be the disqualifying event. So you have to be very careful if a company decides to start investing in property or shares or something like that, just to make sure that the trading status isn't compromised, because that would be a disqualifying event and mean that the CGT relief would be clawed back. If the EOT ceases to meet the all employee benefit requirement. So as I said at the beginning, all employees do have to benefit on the same terms. And if that ceases to be the case, then that's a problem. That's a disqualifying event. The EOT ceases to meet the controlling interest requirement. So if dilution occurs for some reason, so that the EOT drops below that 51%, that is a problem. That is a disqualifying event. And you can see immediately how this would be a problem if outside investors come in and want to take a larger stake. You would have to look at the fully diluted position before making a decision, because it could cause a disqualifying event for the EOT purposes. And final, kind of key point to be aware of. Obviously, there are too many to go into every single one here, but key point to be aware of is that if that 40% ongoing shareholder threshold is breached, as we talked about earlier in the Will and Kate scenario, then that would be a disqualifying event as well. So whether a disqualifying event takes place or not is generally within the control of the trustees, depending on the terms of the trust deed. So it shouldn't occur unless it's intentional, such as if they've decided to sell the company on or something like that. But it is possible for it to be outside their control. So you do have to be very careful, both when drafting the trust deed and also just on an ongoing basis, to be aware of all these issues before making decisions. One other thing just to add is that establishing the value of the shares before the sale to the EOT is also really important. If the sale of the shares takes place for greater than their market value, then there is a risk that HMRC will seek to apply income tax on that excess value, because of course the temptation might be for shareholders not to take a dividend, not to pay income tax, but rather to sell their shares for greater than the market value. And of course, as we've been saying, pay no capital gains tax, no tax at all on that. So it is really important to make sure that the value is correct. That's always been the case, but an added reason, and we're going to talk about some sort of recent changes at the end, but there was a change in 2024 where the trustees are now bound to take reasonable steps to make sure that they're not overpaying, essentially. So really important both for the exiting shareholder and for the trustees. Another really important note of caution, and again, this is looking at everything in the round in terms of shareholders' position, is that when you own shares in a trading company, they are generally speaking exempt from inheritance tax. But when you sell those shares and receive cash in place of the shares, that is not exempt from inheritance tax. So you're essentially swapping an asset which is very inheritance tax efficient for cash, which is not. So part of the conversation should be, okay, you're going to sell these shares to this employee ownership trust, you're going to get this cash. What are you then going to do with it in terms of IHT planning to make sure that should the worst happen, you're not going to be in a position where you've created a huge inheritance tax liability that wasn't there previously. Implications for other share schemes in the company. It's important to note that EMI scheme, which is, as you may know, probably the most common or the gold standard really share scheme for smaller companies, is compatible with an EMI scheme, whereas normally an EMI company can't be controlled by another company. It can be controlled by an EOT, so they are compatible. However, we do have to be really careful of the dilution point, because of course if EMI option holders exercise their options and they get shares, then they are going to change the cap table of the company, and it may be that the holding of the EOT is so diluted that it falls below the 51%. So really important to work that out before EMI options are granted or exercised, and just make sure that not so many options are exercised that it could cause this problem in the future. So in terms of the employee bonus scheme, how does that work? As we've said, once a company is controlled by the EOT, it can pay cash bonuses of up to £3,600 per year. They're exempt from inheritance tax, but subject to national insurance. All eligible employees must participate on the same terms, but there can be a system in place to determine the level of the bonus by length of service, remuneration level, hours worked, provided all employees have the same factors applied to them. The company's not required to pay bonuses. It's important to note it isn't a requirement. There's often a point system used, so you might allocate a certain number of points to years of service or hours worked or something like that. There could be a formula, but it has to be fairly applied to everybody. And as we've said, if the all employee rule is breached, then that is a disqualifying event for the EOT rules, and they may not. It may be a disqualifying event, and all the tax benefits may be clawed back. So we talked about a couple of these already, really. Excess over market value, IHT consequences, dilution. I think we've been through those, so we won't go over those again. Just in terms of what happens if there is a disqualifying event. I haven't actually got a slide on that, but if there's a disqualifying event and the EOT rules are no longer met, if that happens within the same tax year of the sale, or the following tax year, then the capital gains tax relief is clawed back from the departing shareholder. That's been the rule for a long time. One of the 2024 changes is that period's actually been extended to 4 years. So if there's a disqualifying event within the first 4 years, then the CGT relief is clawed back. If the disqualifying event happens after that time, then the CGT comes back into charge, but it actually comes back into charge on the trustees. So there will always be a CGT charge when there is a disqualifying event. This most often happens when the company is sold on again to a third party. This is meant to be a long-term employee solution. It is not designed to be a kind of halfway, or kind of do this for a few years and then we move on kind of thing. This is supposed to be a long-term employee solution. So there have been a few changes that have sort of tried to weave in where they've come up, but were a number of changes which came into force from 30th of October 2024. So the point of these was to kind of refine the legislation to ensure that tax advantages are used for the benefit of the employees and not exploited by sellers for purposes that were never within the spirit of the legislation, and also just to strengthen governance and transparency. So we'll run through those now. Firstly, the trustee residence requirement. So, as I said, if there's a disqualifying event after the initial period, so we've passed the 4 years where the CGT relief will be clawed back from the vendor, it will be clawed back from the trustees. So what used to happen was that there were lots of trustee boards who were resident overseas because, of course, they weren't within the capital gains tax scope. So the CGT was never clawed back. But now the trustees, as a body of trustees, must be resident in the UK. That was considered quite a big loophole, actually, for a few years. So it wasn't really a big surprise when that was closed in 2024. Secondly, a trustee independence and control requirement was introduced. So essentially, the former owner cannot keep control of the company. So less than 50% of the trustees must be excluded participators. And if you remember at the beginning, we said that people who are excluded from benefiting from this was anybody who'd had more than a 5% shareholding in the last 10 years. So this applies to the trustee board as well. So former owners can't control the board of trustees because, of course, then there'd be no real change of control. So the whole thing would just be for tax benefit and no actual commercial change. I think I referred to this earlier, but trustees are now required to take reasonable steps to ensure that they pay no more than market value for the shares. So, as I said before, always been important for the seller, but actually really important for the trustees now. And essentially also when there's deferred consideration, any interest must also be paid at a reasonable commercial rate. So a couple of things there to bear in mind. As I explained, there's been an extension to the clawback period for the vendor. So the clawback of the CGT on the vendor is now 4 years following the tax year of disposal rather than 1, as it was previously. Quite a long period then. And as I mentioned, this is because this is designed to be a long-term employee solution, not a short-term fix, just to then do a normal trade sale. Additional information now has to be supplied when individuals make their capital gains tax relief claim. They have to give the consideration for the disposal and the number of employees in the company. So you can see how this links back to the fact that HMRC want to make sure that there wasn't an overpayment for the shares, which is essentially a disguised dividend, and that the employee proportions are correct. So that must now be supplied when the capital gains tax claim is made. In positive news, there was a clarification that distributions made from the company to the trustees of the EOT in order to pay out the former owners will not be treated as a distribution subject to income tax, essentially a dividend, because there had been a school of thought that should be treated as a distribution, which was obviously disadvantageous. So it has been clarified that where money moves from a company to the EOT in order to pay out the vendor shareholders, then that won't be treated as a distribution. And then a final point is, whilst the £3,600 threshold for the tax-free bonuses remains unchanged, it does not now have to be paid to directors. I mean, you don't have to pay it to everybody, but even if you are paying it to employees, directors don't have to be included in that. And this is important because the problem was before that non-exec directors who aren't usually entitled to a bonus were actually caught within this. So the company was having to pay them a bonus in order to keep it fair and equitable to everybody and within the rules, even though commercially they're not usually entitled to a bonus. So the rules have been clarified to ensure that that's not the case. So what do the changes mean in practice? Because obviously we always like to, we look at things in the round, we look at the overall commercial position. So for business owners selling, the tax advantages are still significant, but there is added rigour around transparency, around fairness of the price being paid, and then of course continued compliance for 4 years rather than 1. For trustees, there is more focus on paying the right amount, making sure you're not overpaying, responsibility to do that, and ensuring they remain within the rules, they remain eligible by being UK resident and therefore within this UK CGT net. The companies need to ensure that the rules are kept for the whole period where the EOT benefits are needed. Any disqualifying events must be avoided, otherwise there will be a clawback. And for employees, the good news is there's no change to the £3,600 cap, and arguably the rules around independence and governance may mean that they benefit more in the long run because of the greater kind of focus on fairness and governance. So important to note that those changes only apply to disposals from 30th of October 2024. Before that, not affected, but there are new rules from that date. So that is all the questions that I have, all the slides rather that I have at the moment. Always happy to take any questions if you have them. If you would like to, you're very welcome to ask questions now. Otherwise, please do drop me an email, sarah.gardner@allegro-tax.com. Our next session on Wednesday, the 19th of November, will be on shareholder exit planning. We will be looking at, we won't go at EOTs in huge detail because obviously we've focused on that today, but we'll look at trade sales, we'll look at business disposal relief planning, we'll look at company purchase of own shares, we'll look at MBOs, all the other ways of exiting the company really. So that's going to be the focus for November. I am thinking ahead to 2026 and how we take these sessions forward. So I would really value your feedback on whether you find the sessions helpful, whether you find the structure helpful, and what you would like to see in 2026. So please do get in touch. I'm always on LinkedIn, so LinkedIn message me or drop me an email, as I say, sarah.gardner@allegro-tax.com, and then we can make these sessions as relevant as we can for you going forward. So thank you for listening, and we'll see you in November.